US interest rates just dropped again, and that could affect American wallets in some unexpected ways. The Federal Reserve, that's the US central bank, cut rates for the third time this year by a quarter point. If you've got credit card debt, this is good news. Credit cards have variable interest rates tied directly to Fed decisions, so your rate should edge down soon. Got a car loan? You won't see any difference. Those rates are typically fixed, but if you're shopping around for a new loan, you might get a better deal now. What about mortgages? Here's where it gets tricky. Mortgage rates don't follow the Fed. Instead, they track the 10-year Treasury yield. Here's what that means. When the government borrows money, it sells bonds, also known as treasuries. Investors lend the government money, and the government pays them back with interest. That interest rate is the yield. Right now, that yield is still climbing despite 3 Fed rate cuts. The reason? Inflation fears. Investors worry that inflation, and that's the rise in everyday prices, isn't going away. When inflation stays high, it pushes rates up, not down. That's the opposite of what President Trump wants. He's pushing for aggressive Fed rate cuts to bring those yields down and lower mortgage costs. But investors aren't buying it. If the Fed cuts rates too fast, it could backfire. Quick cuts might cause more inflation, pushing rates higher, not lower. Trump's expected to nominate a new Fed chair within weeks. That person will help shape rate decisions for years to come on what you pay to borrow money.